And let's start our Agile Mondays. So, good morning. This is Agile Mondays, and thank you for joining us and welcome. My name is Elena Gruniuk, and I'm responsible for the Central Eastern Europe at the SME Banking Club, and will be a host today. And each Monday, as always, I'm here with John Mark Williams from Agile Business Consortium and Maria Tsenusa from Integrated Consulting Group. Hello, and thank you for joining today.
Good morning and hello, and thank you very much, Elena and Maria.
Hi, very nice to see you again.
Very short mentioning from my side that our talk is scheduled for half an hour, and you're welcome to type your questions right now from the start into the chat, and we'll be answering them at once. And today, it's a pity to say, but today is our last episode this season, and we decided to wrap up all the series with the topic of agility in practice. So how SMEs are building their agility, and we discussed earlier that SMEs are agile from the core, and they expect actually from all the partners and including banks to be agile as well. So what banks should consider in this context to service SMEs better? And I'm passing the word at once to Maria and John. John, would you start? What do you think on that?
Okay, thank you very much indeed, Elena. Yeah, we've covered quite a lot of stuff around the different ways of I suppose different agile practices around marketing and operations and HR and of course finance to get to an agile strategy. And I wanted to just show a couple of slides actually this morning just to look at what kind of practices a bank might need to follow in order to be agile in the mind of its SME customers. And I think they fall into three areas, and this slide I'm going to put up now looks at those three areas. The first one, the one at the top in the middle, is very straightforward and pretty obvious. The first practice that a bank ought to commit to is committing to customer value. The basic principle of agility is to achieve greater customer value and often to achieve it more quickly and to the greater satisfaction of the customers. As far as the bank is concerned, this is relatively straightforward, committing to flexibility in response to what SMEs need. And of course, that's because there are many, many SMEs and they are not all the same, despite what sometimes we think. Committing to timeliness, and one of the reasons why banks need to be timely and on time with the services they provide to SMEs is because SMEs live much closer to break even. Very often SMEs can't go for months or even years without making a profit. They need to do things which help them stay in business at the time those things need to be done. So the bank can commit to timeliness as an element of customer value. And the other thing, which is pure agility, which is minimum viable product. SMEs don't need massively over-engineered products and services. They need something that does the job for them. So it's relatively straightforward to commit to customer value from the bank's point of view. The other two practices, agile practices, are a bit more in-depth and a bit more complex for banks to commit to. The first one, and I know, Maria, you and I will have a conversation about this. The first one is about communication, and it's communicating to SMEs the competitive advantage. Not the bank's competitive advantage. SMEs are not interested in the bank having a competitive advantage. They're interested in having their own competitive advantage. And it's an absolute must for the bank, if it wants to be agile, to present its agility to SME customers, to be able to communicate to them the competitive advantage they get from dealing with the bank. There are three areas in which all organizations want to achieve success. First of all, improvements in efficiency. Secondly, availability of resources, the right ones at the right time. And thirdly, getting access to markets. All three of those areas are areas in which the bank can help the SME gain a competitive advantage, because banks are used to improvements in efficiency. They spend a lot of time analyzing businesses to whom they lend money, so they know what makes an efficient business. They also because banks are connected to everybody everywhere, are able to help SMEs acquire resources or connect with resources that the SME couldn't otherwise find themselves. Banks are connected everywhere. SMEs are very poorly connected. And the last thing is, in terms of access to markets, banks, pretty much every bank has not just international connections, but connections between different sectors, between different clusters. They can help SMEs gain a competitive advantage by working with them on those things. Maria, do you think that's a valid case to make on behalf of banks and their ability to give a competitive advantage to SMEs?
Sure. But before that, I will go a bit back to the providing customer value. The first one that you said is the easiest to be done.
Well, most straightforward, not necessarily the easiest.
Straightforward, yes. I think at least at the official level, all the banks are discussing about how customers is in the center of whatever they're doing, and this is very nice. But in terms of how the banks are organized internally, this is not always true, because, and I'll go now to one of the topics that I think we tackled in the past as well. The way a bank is organized by departments, by various business lines, the way it forms connections between various departments. Oh, Marcus says he cannot hear me. I hope, can you hear me now?
I can hear you. Yeah.
No, I can hear you as well. Yes.
Okay. So the way the bank is organized is actually something that is for themselves, to make it more efficient internally. Few banks have started to really go around committing customer value, but yeah, I see that Marcus is. I hope, Paulina, you can deal with Marcus. We need to reload or something. So few banks are actually really committing to providing customer value and organizing themselves around that, because that is the tricky part, and this is how you're becoming more agile, and this is how you're adopting some agile practices, going around and making teams around what customers value most, and let's put all the people around it that are from various specialties, let's put them in a team, let them focus on one product that is important for the customer. So leaving this aside, the organizational structure, I think, is critical in order to be able to really focus on whatever the customer is valuing from the products in the bank. Going on the competitive advantage, I really like the idea of not communicating necessarily about our product, but communicating to SMEs about how they can improve, how they can be better if they use this and that products from this bank. So not really pushing the products, but being there when you need it. So it's like, I like this idea that we are not launching something. We are here whenever you need us for something. And I've seen some projects flying around in Central and Eastern Europe, and I think Olena knows them as well, of banks that are starting to analyze SMEs in the sense that what is critical for this client segment, and try not to be only a service provider in terms of payments and credits. Let's put it very, very simplified, but also try to figure out where are the areas in which SMEs are lacking competency and they are really struggling in running their business. And actually the banks can come and come with the support. And you see the concept of platform that is picking up quite a lot. And you see banks that are trying to have this marketplace in which they provide support functions for SMEs in terms of legal services, access to better legal services, tax advice, whatever, on the software side, how to build a site, this kind of free stuff for SMEs in order to get better, but also launching a marketplace in which they connect SMEs with another. They make sure that SMEs can reach not only their city, their area, whether they're operating, because the bank, as you said, John, the bank has a network, and SMEs would be would die to have that access to the market. And for bank, this is something that it doesn't cost much. You just have to think as an SME in order to see that, okay, I can give this for free. It's something as a service that will be highly valued by an SME.
Yeah, and it's interesting, that last point, because there's a marvelous map that I've seen on the internet, which is a map of the world, and it has about 300 multinational companies superimposed on it, and all the connections between them. And it's like a bowl of spaghetti. Of course, multinationals are connected everywhere. The customers, competitors, governments, absolutely everybody. SMEs, as I mentioned before, are relatively poorly connected. And if we think that actually what everybody is trying to achieve is innovation, if the competitive advantage the bank can bring to the SMEs will support innovation. Innovation is a function of ideas. Ideas are a function of connections. And in some ways, the best competitive advantage that the bank can give and can offer to SMEs is its connections, because that will help in all of those three areas: efficiency and resources and access to markets. And the point you make about the customer value commitment, you're absolutely right. It is, and I add to what I said before, I think it's not enough to commit to customer value. One then has to do something, because we can sit here and say, well, we commit to customer value till the cows come home. But actually, if we don't go out there and do something, there's no evidence of it. So absolutely right. So interestingly, the commitment and then communicating that commitment and doing something with it leads us on to that third circle. How do we, or what do we do after we've said to SMEs, actually, we commit to your benefit, we commit to your competitive advantage? What do we do then? Actually, what we do is we collaborate, because in any service business, the service outcome is always co-created with the customer and the provider. And it doesn't matter if that service is banking or insurance or hairdressing or anything to do with a service, it's always co-created between the two. And in the past, I think many of us as bankers have thought, actually, what we do, and then SMEs buy it. Actually, no. We need to work with them. We need to collaborate with them. That means we need to engage with the customer. Now, it's no use actually just saying, okay, we'll go and collaborate with them on everything. We have to collaborate them on what SMEs want and need from a bank. And I've put there, collaborate on core competencies, because it used to be the case, used to be thought that there were three core competencies in banking. It was called customer service. We'll call it customer engagement now, transactional ability, and risk analysis. And we do actually need to collaborate with the customer on all of those. No point trying to give a customer service without working with them. So to deepen that collaboration, to make it collaboration, not just service provision, customer engagement. It means getting not just closer to the customer, letting the customer get closer to us, pushing these competitive advantage benefits. Secondly, in terms of transactional ability, actually, the more we know about our SME customers, the better we'll be able to provide transactions which are flexible and timely and minimum necessary, as we mentioned in that commitment to customer value. The transaction can be more effectively and more importantly done for the SME if it's done at the right time. So we need to talk to the SMEs and listen to them. And then we need to think about, of course, how do we analyze the risk? And it's not unusual to see banks asking SMEs to pay for the due diligence before they'll be lent money, for example. That's standard practice. If an SME is going to spend money on analysing a risk of itself, then it needs to be doing that with a bank that it knows is on its side. Because SMEs don't just want to spend money on due diligence, they need to work with the bank on analysing their risk. And the more the bank understands about the SME, the more they will be able to gauge that risk. Maria, do you think this is valid?
I have a lot of notes made.
I'm sure, yes.
I was still writing when you asked me. So I think any banker will start with the question, yes, but how do we do it? Because SMEs are tens of thousands of customers. So it's a volume business, more or less. Micro, if you go even lower down the market, micro companies are so many. So how do you manage to get the customer involved and still not do something that is completely dedicated for each customer, to have each transaction different for each customer? Because at the end of the day, banks are running a business, and a business, yes, needs to make money. It's not charity, it's a business, needs to make money, needs to be efficient. So how do you manage between these two worlds in which you want to co-create because it's relevant, you feel the benefits of that, and it's still at the same time you need to be efficient? And I think this is the most scary part in which most of the banks are getting stuck. Indeed, working with SMEs is a volume approach business rather than transaction by transaction. So it's not a corporate business. This is actually the formula that a lot of banks are struggling with when they are new in this segment. But at the same time, trying to constantly understand and being there in the market and talking to the customer is actually going to give you the vibe that you need. And it doesn't mean that every credit facility that you give or every current account needs to be, needs to have different feature for every customer. So then at the end of the day, you cannot simply manage a business with 3,000 lending products for SMEs. But it means that from the way that you are, and I go back to the way the banks are organized, the way that you're organized internally actually aims of being flexible to your customer. You're having products that are modular. You're having stuff that you can either put in your basket or take it out. And you're trying to design the products with the modules that you have researched to be relevant for the customer. Because in the past, all models were like, innovation is, here comes a great guy, has this great vision, everybody's following, everybody wants to be Steve Jobs. Statistically speaking, we are not. So what is the rest of the world doing that needs to innovate? Because we are not Steve Jobs. And actually, this is the new pattern that you see in the world, the co-creation that you mentioned. Let's not be arrogant as bankers and say, we know better, we have the data, we know better about the customers. Sometimes data are not sending the subtle messages. And sometimes actually working with customers and doing these MVPs and constantly getting feedback on little pieces of product, which are not perfect, but they are, a design in the making. And this is the way that you're starting to really engage customer. So customer engagement is not only in the sense that customers are rating us on the NPS score. We have the best NPS score in the market. This is like a bank discussion, yeah? What happens in the board of the bank? We are following the NPS score. We want to check because it's in our KPIs. If it's number one, it's good NPS score. Customer engagement is exactly as you mentioned, John, is really calling the customers, really getting them to build your products. And then going to the transactional ability and risk analysis. I think if you twist it the other way around, this is a great advantage for the banks. Once you start to understand how SMEs are functioning, and it starts from them, not from yourself, you then can start to actually analyze patterns in their transactions and then start to be relevant on the risk analysis. This is, again, one of the biggest struggles of banks with this segment. This is the riskiest segment in a bank. It does not have the volume that a retail business has. Yes, to go away in a portfolio analysis, so then to enjoy the benefits of portfolio analysis. At the same time, it does not have the big numbers, the big profits that a corporate has. So you're somewhere in the middle with some of the highest probability of default as portfolio. So what do you do as a bank? And some banks go on the direction that it's still relationship based. approach with SMEs, and then they're struggling with costs behind that, because relationship based can be also misunderstood for we make adjustments to the products according to each SME, whatever he or she wants, without seeing if it's a trend in the market. So then you end up with lots of products that you cannot simply manage. Or some other banks are going in the approach of a binary approach. It's either 0 or 1. You take it or leave it, which is pure retail. And then, they see themselves not gaining too much market share in the SME. So from a purely selfish point of view, as a bank, if you manage to understand the transactions in the account of your SMEs and work with them in the design of the products, you will be able to give them loans when they need, and also to have the proper early warning signals in place, which could be very different than coming from a corporate world. And I will give here just a funny example. I was a corporate background and then started to go down the market and working with SMEs and micro companies. And one of the early signals that we had at some point was variation in working capital cycle. Basically, the number of days for receivables. Yeah, it's a simple ratio. And once you have a variation, you see, oh my God, there's a big problem with collection in this company. But then the reality for small companies is that they might have receivables of 1,000 euros, and then the next, or 2,000, or depending on the company, and then these variation don't really mean something in actual terms. They just mean that they forgot to, register something or whatever. But with the corporate analysis coming, you would end up with so many triggers in following up in the portfolio of SMEs that it's simply impossible to manage it.
Yeah.
So transactional ability is really gold for risk analysis, and doing a proper risk analysis without having too many false positives, without having too many triggers, and just be there, not pulling out the lines because we're getting scared, just adjusting our products according to what they need.
And that's really, really important, because you mentioned before it's difficult for the bank to have an unlimited number of products. It is, and actually there's a sort of remedy for that. And there's a way for the bank to at least double the number of products that it's got, or more, without having to do anything at all. And it's about engaging with the SME, because if the product is co-created with the SME, and the SME learns from the bank how that product, how that service transaction can become more efficient for the SME will change its behavior. Because SMEs look for opportunities to gain competitive advantage. So immediately, for every product that the bank has, it is potentially multiplied in its market application by the number of behavior changes that the SME customers can make. And I remember, I think it was Capital One, the American company, and when they were pushing credit cards many, many years ago. And I remember somebody saying to me, they had about 10,000 different products. And I said, they're a credit card company. How can they have 10,000 different products? It's a credit card, right? And they said, no. They have at least 10,000 different personas for the people in the marketplace. There are millions of customers, so 10,000 isn't actually that large a range of products. All they had done, and this is where technology starts to really, really matter, they had looked at the data about the spending patterns and repayment patterns of thousands and thousands and thousands of customers, and had come up with a number of variations. So if we do the same with SMEs and accept, not only will we be able to create from the data we've got lots of different minute permutations, not necessarily changes in the coupon, but changes in the risk score or whatever it is, but we multiply the opportunity for change by the fact that SMEs will themselves change their behavior. And they will change it in a way which is beneficial to the bank, because if the bank is looking for competitive advantage with the SME, it will also benefit the SME. And the short version of saying this is, it's up to us as SME bankers to try and improve the quality of our customers, because actually that will improve the quality of their businesses. Now that brings us quite nicely, actually, to the question of risk. And for the almost the final slide, I've got a little chart here of SME attitudes to risk. Now you'll notice, if you see the small print in the bottom right hand corner, this is very old. I came up with this about 20 something years ago, and it was in a discussion with a group of SME bankers who none of them had ever been in an SME. And of course I had been an SME a number of times, and they were all talking about risk, SME risk and attitudes to risk from the point of view of the bank. And I had to stop them. I said, hold on a second. Actually, I don't think you're quite getting this, because you're not seeing this from the customer's point of view. 28 years ago, no surprise. However, I just explained to them that, and this is a very big generalization, okay? There are effectively two types of SME in the marketplace. Those who want to grow, and I'll call them scale-ups because that's a relatively new but very common word for growth-focused SMEs, and those who we might call lifestyle SMEs. And they're the ones who do want to grow, and they want to grow to a certain point. So if you look at this chart, the horizontal axis is growth, the vertical axis is risk, and this is the SME's perception of the risk associated with certain levels of growth. So as we go along the horizontal axis from low growth to high growth, we look at the lifestyle SME, very comfortable with growth, and in actual fact they see the decline in risk very rapid as growth grows. So it drops probably twice as fast as on the risk axis as it grows on the growth axis, because they know if I grow, it reduces the risk. And then they get to the point about halfway along their growth axis that I've got there, where they think, this is great. I've got a good, profitable company. I get a couple of really nice holidays a year. My children are in good schools. I've got a lovely house. It's all paid for. A couple of nice cars. My friends all come to my house for dinner and they marvel at the artworks in my house. They're having a great life. It is a wonderful place to be, and I wish that I could be there. It's a fabulous place for that SME to be. And they then say, why would I risk this for anything? When somebody says to them, the bank or another SME or a friend says, oh, look, I've got this great project, got this great idea, just invest some of your money in this. No. I like what I've got. I know if I keep doing this, it will look like this for the rest of my life. Thank you very much. So they stop. They are happy with their lifestyle, and nobody can fault them for that. That is not wrong. That is perfectly rational and sane economic behavior. Except that the scale-up SMEs think slightly differently. They also see very low growth as high risk, but as they grow, they tend to be a bit more circumspect about how much risk is being got rid of, okay? Because they understand that growth, especially for an SME, growth is not normally a straight line, and it actually, for the early years, and sometimes in situations like we're in at the moment, because they are not that far from break even sometimes, the growth curve can slip into a negative growth curve from time to time. So they're a little bit less, and this is attitudes, remember this chart, they're a little bit less sanguine about how fast risk disappears when we grow. But they do get to a point, and notice as they pass that central point on the growth curve, they're still happy to grow. And actually, the further up the growth curve they go, the more confident they become about how much risk is left. So high growth, very high growth, is the least risky place for a scale-up SME to inhabit. And this is where they differ from the lifestyle SMEs, because they understand actually nothing stands still. I get my company to the place where I've got all of these nice things. I need to keep growing, because if I don't, the market will overtake me. Markets are dynamic. They are not static. And that's why when I talked before about increasing or improving the quality of our customers, actually SME bankers could usefully learn to differentiate between scale-up and lifestyle SMEs. And two things: one, focus on the scale-ups, and two, encourage some of those lifestyle SMEs to think a little differently. Maria, what do you think?
I was just thinking that I have like two examples from my banking experience in which you meet both types, and you're not happy for various reasons with them because they're not. When you do projection as an analyst, especially if you're quite junior, you want to have like a steady increase, like a 5%, 10%, nothing too radical. And this is how the projections. And then when you analyze companies, a bank gets very nervous around volatility. Yes. So what do we have here? We have the lifestyle, which probably as a pattern would be profitable business, low growth levels from one year to another, but protecting the profit. So taking on only projects that are protecting the level of income. A bank will not be satisfied with that one because you don't see turnover increase. And then and especially in this region in which you are used with business growth that is a part that is bigger than Western Europe, and you're wondering, but why aren't you growing more? Why aren't you growing faster? We want to propose you a new credit line. We want to give you this new product. We want to finance your future growth. And then the shareholder that you're discussing with is saying no. And then it's like you simply don't get it as a banker. And then there goes the opposite, the scale-ups, which want to go for every opportunity, as you mentioned, and probably what is happening here, you'll have shrinking profits. And then as a bank, you'd say, yes, you increase, but there's a problem with your profitability. And then, because as a bank, you're not satisfied with either of them for various reasons, as I mentioned. But as a bank, if you're looking only at what the history of the historical financials of each company, you don't get to have the essence. And this is actually what happens when you're inputting the data into a system, and that system has a rating that, puts turnover increase year on year, has a certain percentage of indicating a probability of default or whatever. And you're simply judging the company by these financials, not understanding what is their core, what is their purpose, where they are heading to, and not asking these questions actually, and adjusting afterwards your expectations and products according. Why do you laugh, John?
No, I think that's so accurate. Really, it's so accurate. And because one of the things I remember having a conversation with an SME banker just a couple of years ago, and he was very clear about the fact. He said the problem with SMEs is entrepreneurs, they just take risks. And I said, well, no, actually, they don't. They calculate risk, and then they decide which ones to take. Entrepreneurs don't just jump into every imaginable risk. Otherwise, actually, there will be far fewer successful ones. The ones who are successful are ones who will take a risk. They will calculate this. If it's 80% likely to be a success, they might try it. They take a different attitude to risk from the attitude taken by the risk committee in the bank. And that really is the point of this chart, that as you said quite rightly, they need to get into the mind of the SME. They need to co-create the risk analysis between the bank and the SME. And the only way to do that is actually to get to the essence of the SME, get behind the figures. And it's impossible to do due diligence properly from a piece of paper or a chart on an Excel spreadsheet. One has to go and see the SME, or ask the SME to come and see the bank. Nowadays, of course, it's much easier to scale a conversation because it's acceptable not to go and see somebody. You can talk to them screen to screen. However, that idea of getting the essence of the SME, I really like that, is what this chart is all about, really. So, there we are. I was going to finish by just quickly reiterating, these are the things that we've covered over the course of this season. We looked at what are the components of Agile Business Strategy, people and finance and marketing, and of course, the operations, which includes all of the digital stuff that we haven't talked a lot about, but which underpins the data and the analytics, which enable us to do risk analysis and stuff like that. So I think I've really enjoyed this season. We've covered an awful lot of ground, and I have learned a huge amount actually, from both from Maria and Elena and from our viewers and that. It's been very enjoyable, actually.
Yes, actually, I can say the same, that I probably have learned a lot about agility and being agile during this series, this season. So I hope we will continue next season as well. If I may just shortly add here, like if we got back to these two previous slides, I mean, this one is perfect. And this is actually, if we look at the picture of SMEs here, for example, in the region, so we see actually that the biggest number of SMEs and micros as well are the ones that are being lifestyle here, taking into account this chart. And I think that less than 10% of the SMEs are scales ups, because, well, maybe this is also depends on the market you're working each. So if the local market, this is like my observation. So if the local market is good enough for the ones for the SMEs to be lifestyle, so to earn enough to feel comfortable, let's say, then they are tending to be a lifestyle companies. Or maybe this is vice versa, just because their lifestyle. I mean, if you take the mindset in the first, so if you are a lifestyle, that then you choose the product you do. Like this can be a local restaurant or local hotel, which is not which is as the business is not scalable, and you actually a lifestyle. So you do this business. This is a family business, and you do it, years, for example, and this belongs to one family, for example. And scale up, so this is actually, so these are the products that you can earn on them only if they are scalable. Like, you're producing, you're a startup and producing some applications, then you should have a scale up mindset to earn, or you are operating on a very limited small market that you think of, you should think from the start, for example, of exporting your service of your product, then probably you should be a scale up as well. So this is, this is a very good one, and yes, the business models are just different, which banks should actually take into account when underwriting these customers for financial products.
Yeah, I think that the key thing here is that context is everything in deciding whether an SME is lifestyle or scale up, and that's for the SME to decide as well as the bank. The other thing is, no matter which one of them we talk about, they both need to be agile when something like the pandemic comes along, because otherwise they're not around afterwards.
Exactly, and as you said, that as they are very close to break even, so they are mostly agile from the code, just because they have to. And if we turn back to this slide, and especially to this third circle on communicating competitive advantage, this is actually a very on the point, and this is what we see actually here in the region, in the CE, that banks are starting, and we're discussing this during probably recent 2-3 years, that banks are started thinking that delivering, so the banks call it value-added services or non-financial or additional services for SMEs, while for SMEs, these are actually the core services that they now want to get from the banks, if the banks want to be a partners for SMEs. So SMEs are not expecting, I mean, just because this became a standard one, like transactional banking, or when you have everything already on the online banking and mobile banking, so this became a normal, and this does not differentiate banks in the eyes of SMEs anymore. So the SMEs are expecting now really more and more for banks to deliver such services for them as accounting, as cash flow, helping them to to project the businesses, as giving an access to different marketplaces or trade portals, so to help them to find new counterparties, maybe abroad. So this is the thing that, for example, Santander did, actually started, I think, one of the first on the market, and actually SMEs are expecting this, and this traditional banking, like transactional banking, is becoming or tending to become like an invisible one. So this is just the SMEs don't think about this. So this just is staying just somewhere underneath as a standard function of the banks. But to be really a partner, and for SMEs to consider banks as partners, so they really expect now. They're starting to expect. So if earlier they didn't, So now they really started to expect that the banks should actually deliver for them some services that will help them to manage and to grow their businesses.
Absolutely, and I think the last word for me would be when I set up Breakthrough at Santander. The slogan we used was, "This is not banking, this is business growth," and that's how we put it out. And it was growth for business. So.
Yeah. So Maria, would you add something for the end?
Yes, I think what was the common idea that we had all in the past 3 months in the Agile Mondays, it was always built around customer. And the common idea was, I'm trying to summarize what we have been discussing, because it's not about Agile. It's not about how you make it in one department or another. It is about how you are relevant to your customer as a business, be it a bank, be it an SME, be it whatever field that you're operating with. And let's not forget the idea of value creation that goes around value streams. So how do you look at the product that you are delivering to your customer as being part of a full experience, end to end, not only does a simple product, but whatever goes around it. What are the ecosystems around your product? So let's take a step back, have a bigger picture, and try to see from the eyes of the customer, try to see what they need, how do they use and look at our product, and start from here in delivering whatever we want to deliver to the customer. And if you want, it can be innovation in the finance department that we need, innovation in operation, innovation in marketing, whatever that is, regardless of the field, starts from the customer and understanding the customer. So that is the, let's say, the wrap up that I dare to make.
Yes. And John, we are happy to have you back with the video.
Yes, my video disappeared for no reason whatsoever.
Yes.
But I just want to say thank you very much, actually, for this season, because it's been absolutely tremendous being able to talk to everybody. And I hope that we'll see just as many people back next season, actually.
Yes. I hope so either. So thank you for your contribution for all these 3 months. And it was really such a pleasure to do these talks with you. And yes, see you next season. Goodbye.
Thank you.
Have a perfect summer.
Bye.
Thank you. Bye.